Hello and welcome to another video. So today we're going to be going through one of the themes in the latest edition of the weekly macro themes report. This report is designed for institutional investors, portfolio managers, especially those with a multi-asset scope and those with an interest in the macro. And so what we're going to be looking at today is the USDCNY, so that's the US dollar versus renminbi, the Chinese currency. And so what we're going to be focusing on is really a couple of charts that set up the direction for probably the next move. So first thing to note is that you'll see there in the red line, that's the exchange rate itself. It's been locked in a very tight range there after fairly persistent devaluation pressure on the Chinese yuan. And a lot of that it's not that the fundamentals have changed. The fundamentals still continue to point to more devaluation pressures. It's just that the government has really stepped in there, interventions to try and calm the market down, stem the movements there, because what was going on there was that you'd have a weakening in the currency, and that would put further pressure on people to go ahead and try and take money out of the country, the capital flow issue. And so it would have a kind of a circulatory effect on itself. But if you look at the red line there, that's the interest rate differential for China versus the US, and that's really only going in one direction. The People's Bank of China probably isn't really going to be doing much in anytime soon, versus the US Federal Reserve is already on a hiking path, so that's only going to increase the pressure there. And if you look at the Bitcoin versus the USDCNY, ever since that one-off adjustment there, we've had fairly close correlation. And I look at this chart and I sort of jokingly say, what do you really feel about the USDCNY? This is pretty much telling you what the market's feeling right there. And arguably it should be trading above 7 rather than at the point there about 6.9 where it sort of stalled out. So that's sort of I guess particularly that one's the fundamental view, the USDCNY. So I'll just zoom in on that chart there for a second. So that's really the chart to look at. And even before that one-off shock, it was a surprise. I didn't predict it, but at that time, prior to that line, it had already been saying that the pressure is on. So and that pressure still remains. So that's probably the key chart that that anyone who's interested in that exchange rate should be looking at. The next ones what I would call timing indicators. I mean, everyone has a view that China's, it's unsustainable and everyone's pretty bearish, but no one really gives you timing about it. They just say, doomsday is coming, and they've been saying the same thing for the last 10 years. It's pretty useless, really. And you shouldn't give those people much attention. You should be paying more attention to people like me who actually give you some useful timing stuff around it. So these are a couple of indicators here that I would pay some attention to. They don't always work, but they are they have provided some insights, some useful insights here. So I mean, really, what these are pretty much the same thing, but what they're really saying is the market complacent or not about it? And prior to that one-off shock adjustment, which was a surprise, people had completely lost interest in it, and this is Google search interest. And you can see that whenever people lose interest in it, that's usually the time that I guess the authorities decide that they can take their foot off the pedal and let the currency go a little bit. And then over this one is more of a market-based measure. So you've got there in the bright red line is implied volatility in the forex markets. So it's kind of like the VIX. And the dark red line is the non-deliverable forwards, the premium of the 1 year versus the spot. And then again, you can see, they'd gone to very complacent levels. And pretty much, I mean, yeah, it was justified because it was locked back into a range then. But, I guess back, if you look around here, for example, where volatility had run down, the premium had come down quite a bit. It's the time to be less fearful is when everyone else is fearful. That's a common adage in the stock market, and it's pretty much running through here. And here you've got volatility coming back down to levels that we didn't see until back then. So, I would say you look at these charts. There's no two ways about it. The market's completely complacent to any big move in the currency, and they've been lulled into thinking that because it's been put back into a fairly tight range. But as I said back here, I don't expect that to last, and that's the conclusion I came up with in this edition of the report. And so I've been having good feedback about this report, and if you want to have a look at it, or if you're interested in a trial, please get in touch. I'll put a link to this in the information section for this video, and if you have any questions or comments, please do leave them below, and make sure you subscribe to the channel.